The real estate markets, both residential and commercial, are looking pretty precarious to me and kind of vulnerable going into 2026. I thought it was only right that we'd review them today. So I want to start off with this chart, which was put out by Joseph Politano quite a while ago, earlier this year, but it shows a startling trend. And one that has completely flipped the script on the return to office narrative that was supposed to fix the vacant office issue. But if you live in a major urban center, you've probably noticed this. There's a lot of office buildings up for sale. There's a lot of office buildings that have been up for sale for a while. So, what's going on? Well, here's Green Street's commercial property index. And we can see that after the bubble burst from the ZIRP era, the 2021 2022 zero interest rate policy, where we got to basically just get free loans, more or less, that inflated commercial properties like mad. And when it popped, when rates began to rise, return to office began to fizzle out a little bit, well, you can see that it's just down big time, almost as bad as any other time since 2008. And the recovery's been pretty lackluster. In fact, we're actually seeing a downtrend in the more recent months of data. But not all commercial property is the same. Remember that commercial properties encompass a wide range of assets. Here's the breakdown. We can see that over the past couple years, industrial, manufactured homes, self-storage have all done really well and actually have absorbed a lot of the gains that were lost in offices and malls. Lodging and healthcare is coming back a little bit, but they're flat the last 7 years. And so this category of commercial real estate is still hurting. There's still a lot of trouble in offices, in malls. Whereas the entire sector may look like it's churning out positively, it's mostly industrial parks. Here's another good image from Green Street showing the change from the 2022 peak. We're still down almost 16% on the values 3 years later. And going into 2026, it's not looking much better. Even in 2025, we really only improved about 2.5%, which was below inflation. So if you owned an office building, you had a negative real return this year. This also explains the divergence we've been seeing in REITs, real estate investment trusts. We can see here that the office REITs are doing much worse than the total broad index that includes residential REITs and mortgage REITs and things like this. Well, over the last year, the broad index, VNQ, is up about 3%, on par with the average of commercial properties. The office index in particular is down almost 9%, and at its lows, we're down over 20% this year. I can already hear some REIT commentators screaming, it's a bargain, and you're not going to get it any better. But I would argue that these kinds of charts show a lot of stagnation and do not make me bullish for real estate, especially on the commercial side, going into 2026. But just like all things in real estate, there's a lot of regionality at play. Check out this map showing us the change in jobs between major metro areas. And we can see that places like the Bay Area in California, places like Kansas City and Washington, D.C., unsurprisingly, have seen a lot of drawdown in jobs, decreases overall, even while the entire economy is adding jobs. If you want to know more about what's happening with jobs, check out last week's video. But jobs impact things like office spaces. If you're not hiring, you're probably not buying new office buildings either. And that's a problem for a lot of these office buildings that expected to break even by now from their 2022 lows, and they're still down over 16%. So residential housing is a little bit more complex, mostly because of the 30-year fixed rate mortgage. In America, almost all mortgages taken out are of this specific kind, fixed rate for 30 years. Now, I covered this before in my Why the 50-Year Mortgage is a Disaster video, but I just want to bring this chart up again. This is the real housing prices, so housing prices minus inflation, compared across three major economies, US, Canada, and Sweden. Notably, Canadian and Swedish housing prices have fallen because they're economies that have adjustable rate mortgages as the common vehicle for a mortgage. So when interest rates rose, so did the rates on most people's mortgages, which caused them to need to get out of some of these mortgages, which caused housing prices to fall. In the US, housing prices didn't fall and they've already rebounded from their highs because people who had a fixed rate, oftentimes if you bought it from 2020 to 2022, you got a rate somewhere around 3 or below 3%. That's below current inflation. Your real return on your house is positive even if it doesn't appreciate in value because the leverage you got with the mortgage that was sub 3% allows you to have really cheap financing, cheaper than the rate that your money is being devalued at. That is a huge asset to have. But it also means that there are a ton of unmotivated buyers. If you want a new house, but you have an existing property and that existing property is financed at a rate around or below inflation, and if you got a new property, you'd have to finance at today's interest rate, which, as I will remind you, is 6.2%. Why would you do that? It just makes no sense. So instead, what we're seeing is people just not moving. Why would I leave my house? I'll just keep it listed for the high price that I want, pay my really cheap, almost free money mortgage, and wait. So the lock-in effect is keeping residential prices high. But there's still a lot of pain in residential housing, and we're seeing this because there's a lack of buyers. All of these unmotivated sellers create unmotivated buyers who can't afford the high prices and high rates at the same time. So they just don't buy anything. And we're now seeing that there's more sellers than buyers on the market. It's most indicative in charts like this from Lennar, who is a home builder. And they have increased their sales incentives, the freebies and other things they give out in order to try and entice buyers into new constructions. Those rates are now higher than they have been since 2010. And that's a problem because it means that they're not able to move inventory. No one's buying new houses. It's gotten so bad that the new construction premium, the difference between existing homes and new homes, has shrunk to basically zero. 10 years ago, this was nearly 40%, where you would pay an extra 40% premium because it's a new house. Houses are kind of like cars in this way. If you buy one new, as soon as you take it off the lot, it's lost value. Now it's pre-owned. But that premium has been shrinking over time, and now it's evaporated. It is down to zero. So there's no excess premium in buying a new construction versus buying a pre-existing house. That's really unusual and really shouldn't happen in most markets, but it's happening in the US market right now. It should also be of note that some of the new construction premium falling is due to houses being moved outside of core suburbs. So as suburbs in places like Dallas are expanding towards the Oklahoma border, they begin to lose value as they're further and further away from the core. And that erodes some of the premium since these new developments are coming up out of nowhere. Take a look at this from the National Association of Realtors, where we can see the median age for a home buyer is 59. The median age for a first-time home buyer is 40. And we're seeing this dichotomy where of people buying these multi-generational homes, these larger houses, 27% of them are citing that their adult children are moving in with them. Young people who can't afford to live on their own, who can't get their own home and now can't even rent, they're moving back with their parents, and their parents are buying bigger homes because they have equity and older rates that allowed them to accumulate this wealth. It is to note that the top reason is still to take care of aging parents, but this children over 18 moving back is rising quickly. But even some buyers are starting to have problems. Take a look at this chart. I posted this to the community tab maybe a week ago, and it's been burned in my brain ever since. On the top left, we see new 90-day delinquencies. So this is how many new mortgages are being are going unpaid. And we saw that throughout the last 2 years, there's been a huge spike, right? Reduction in income, layoffs, and people having to change jobs, other things like this. Unemployment has spiked. Basically everything except for national emergencies is running up. But most of them have peaked already, and they're starting to come back down a little bit, which is a good sign. Except for this bottom left chart, no contact. which, as far as I can tell, is just people ghosting their lenders and just burying their heads in the sand and hoping they don't get foreclosed on. I really worry about some of these homeowners, and this trend has baffled me. So if you think you can explain it, please leave a comment below. I'd love to hear your theories. Okay, so this was a rapid fire chart session that painted a really bad picture of the housing market. And I think it's right to do so. The housing market does not look good. The kids are moving back home. And ultimately, I don't know how we're going to sell these office buildings. I think one of the solutions is to convert them into housing units. There are a lot of developers that don't like this idea. They would prefer to sell their office buildings at a premium and keep them that way. But ultimately, in some of these urban cores, people are more and more working from home and would be happy to live in a converted office building. We need the housing units in order to bring urban housing costs down. And this seems like a win-win for me. But it requires the willpower of the developers and the willpower of the politicians to rezone the areas. And without those two things, which we're moving toward, but at a really slow pace, I don't know how offices are going to see any return. This chart is a little bit of a positive note, showing the showing the real estate purchases by institutions, and we've seen that over the last 2 years, while it has been negative, it flipped positive this year. It's still a very slight number. 4.5 billion seems like a lot of money, but it was nowhere near the frenzy that got to 10 times that much in spend on real estate, most of which is now sitting as unrealized losses in these office buildings they refuse to convert into housing. But they're returning as buyers, and this is notable. If institutions are buying, it means that they're calling a bottom, and they think that there are more gains ahead. What I'm curious to see is what institutions are buying. That data hasn't come out yet, but when we get it, I'll make sure to make a follow-up to this. So, if you're a real estate investor or an investor in REITs, I'd recommend exercising a lot of caution. The entire sector seems really vulnerable to me, and I don't see a path to recovery. The only constructions that we're really increasing and really working toward are data centers, and those are mostly unrelated to commercial ventures. If you're a data center REIT, maybe this is going well for you, but otherwise, most REITs own these industrial parks and office buildings, some of which have done well, some of which have done poorly, but neither of which look like have a clean, solid path forward. So for now, I believe that the situation in real estate is tenuous, and there's going to be a lot of churn moving forward. If you're a prudent investor, this may spell opportunity. But if you're someone investing in the broad indexes in real estate, VNQ, and funds like this, I would recommend watching your position sizing. Don't let it get too heavy. If you made it this far, you're one of 30% of viewers who do, and I really appreciate the time you took to watch this. I think you'd really enjoy my newsletter. It's linked down in the description. I send it out once a week for free every Sunday, and it's full of ideas designed to make you think and give you perspectives that you don't get in the financial mainstream media. Thanks for watching, and I'll see you next week.